Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Erik Clapsaddle, our Senior Fixed Income Portfolio Manager. Erik, this is our second of three videos as we talk about the investment outlook for 2025. Obviously, with the fixed income person here, we have to talk about the Federal Reserve, and we know the Federal Reserve has been very inflation focused for pretty much the last couple of years and will continue to do that. But we also noticed that they're talking about the labor market a bit more. And I think 4 or 5 months ago, you were here talking about the labor market. So let's talk about the Fed and the labor market.
Sure. So, as Paul mentioned, we were here in July and we talked about the labor markets, and we saw some softening of the labor markets, but that's coming off of some really tight levels, really historically tight levels. But since then, since July, we've seen labor really stabilize, and to some extent, I would just say go sideways. Unemployment rate still hanging around 4.1%. That's about where it was at that time. Job openings still slightly exceeding unemployed people. Normally unemployed people slightly exceed job openings. And then last but not least, the one that we've really kind of honed in on, which shows a little bit more softening, has been the job quits rate, which is basically the percentage of people that are quitting their job for whatever reason that may be. And the lower that number is, basically the less confident individuals feel in leaving their current job. And that is at its lowest level since about mid-2015. You're going to see in this chart something that we've been talking to our clients about for a few years. And that's just the difference in consumer confidence and small business confidence, or what they call small business optimism. It's rare, but it's been happening, and it's happening at a little bit different level than what we've seen in the past. And you start to ask yourself, what are the precise reasons why? We don't know the exact reasons, but intuitively we can kind of put one and one together to figure that out. You think about the consumer, higher rates, inflation should have hurt them, but they've seen housing prices go up. They've seen the stock market rise and bond markets do well the last year and a half. On the flip side, small businesses had to deal with the cost of goods rising, wage pressure, finding good labor. Higher rates mean more expensive cost of capital. Not exactly sure when it goes back to a more normal state where they kind of tread side by side with each other, but eventually we'll get there. It just may take a little bit of time for it to be there.
But it has been an abnormality for at least multiple months now as we continue to look at that. Clearly, we talk about the fixed income markets. Why don't you talk a little bit about how we go about managing fixed income portfolios, and then do you see anything changing in 2025 to our strategy?
Yeah, absolutely. You'll see on the screen our fixed income investment process. And what you're going to see at the center of that, of the graph, is our fixed income portfolios are built around credit analysis, and investment grade credit to be specific. That would include corporate bonds, municipal bonds, and then within there we add things like government agency mortgage-backed securities, treasuries, and other government bonds. On the peripheral to this, core part of the portfolio would be assets like high-yield bonds, preferred securities, asset-backed securities, and bank loans, things that have higher return potential, but they're less correlated with the overall bond markets. How we invest fixed income, though they're not identical to equities, we still have a very similar investment approach. Invest for the long term, build diversified investment portfolios. It's that simple. When we invest in a credit, we do our due diligence, our credit analysis, and we expect that bond to mature one day, pay interest along the way, and when that bond matures, we reinvest it at market rate yields. As far as 2025 goes, or 6 months out, 18 months out, we've spent the past year and a half restructuring our bond portfolios to really resemble what we think, or where we think the economy is at and where the Fed is at. We've increased duration and maturity in the portfolios. We've maintained our exposure to credit. We like credit. We do our work there. And then last but not least, we've increased an allocation slightly to things like government mortgage-backed securities, where it has a government guarantee. But because of this weird dislocation in the housing market, we've been able to pick up a fair amount of yield relative to not just treasuries, but to that matter, investment grade credit as well.
Yeah. Well, we just recently looked at all of our numbers, and we've been able to lock in some nice rates for our clients. Clearly, for most fixed income investors, the starting point of the year of fixed income yields is the first determinant of what you might expect in 2025. So can you talk a little bit about where rates are today and as we start 2025?
Yeah, absolutely. So rates, bonds as a whole, I would be remiss to not quickly just touch on where we're coming from. So if you think back over the past few years, we've seen some pretty strange, unique, and ugly numbers within bond land. The 10-year Treasury hit its all-time low of 0.31%. There was, I always like to mention it, $18 trillion of negative yielding bonds around the world. Most developed economies, their central banks had either zero interest rates, again, or negative interest rates. And actually in 2022, bonds lost 13%. The total bond market lost over 13%. With that said, hard to imagine, we are very constructive on fixed income now, meaning we have a positive outlook on it. When you think about the starting point today at 5 to 5.5%, that's fairly attractive. For the 12-month period ending October 31st, bonds actually have returned over double digits for our clients. Going forward, what that means is if we're able to build a fixed income portfolio yielding 5.5%, that means our clients who have a diversified investment portfolio need to chase returns less. They can either stay where they're at today, neutral, maybe that's 60% stocks, 40% bonds. There's no need to veer too much from that. And in many cases, we've actually seen our clients pull back on equities a little bit and reallocate to bonds as they've become attractive, yielding that over 5%, even up to almost 6% in some cases.
Well, it's been nice after 17, 18 years, the fixed income investors finally get their share of the investment action and don't have to take quite as much risk in the equity portfolios. If you like today's video, I encourage you to share that with friends and family. If you do not currently subscribe to the Market Share, I encourage you to do so by scanning the QR code at the end of the video. And as always, thank you for the opportunity to serve you and your family, and have a great day in 2025.